it's time now for gold to really go through 2000 and stay there. And I think when we reach 2100, it will have a lot of space or room going up from there. So actually, I think now is the time, really time. I mean, it has been this struggle or nothing really happening, and the miners, of course, they get hit also when the equity market goes down. And I think we also have seen this tech hype suddenly again. There is, I mean, as you said, money has dried up, and all new money goes into this hunting these tech companies at the moment. So, and I think that will be over because, I mean, they are really overpriced.
The widely held belief that there is a strong negative correlation between interest rates and gold prices is not supported by the data. A study of 50 years of data shows that the correlation between interest rates and gold prices is only around 28%. This is not considered statistically significant, indicating that the relationship between the two is more complex than a simple negative correlation. There is some evidence that gold prices and interest rates tend to move in opposite directions, but there are also many instances where they have risen or fallen together. The price of gold rose sharply during the 1970s, even as interest rates were also rising. This suggests that there may be a positive correlation between gold prices and interest rates. Eric Strand, founder and portfolio manager of OEG, believes that gold has historically performed well even during rate hikes. He adds, as interest rates approach their peak, we anticipate gold to soar. Gold has already shown strength, gaining 9% during this rate cycle. Eric Strand added that the uncertainty surrounding the U.S. debt limit created a headwind against gold prices. In the end of May, gold prices fell to a 2-month low as optimism surrounding the U.S. debt ceiling talks and strong economic data led to speculation of an upcoming interest rate hike in the long-term dampened demand for the non-yielding asset. Earlier in 2022, gold price rebounded sharply as tensions between Russia and Ukraine escalated. The invasion of Ukraine triggered a surge in commodity prices, which has fueled inflation expectations and led to lower real yields. This has provided support for gold prices. Eric highlighted in his interview that the conflict between Russia and Ukraine has affected the prices of commodities, as European and U.S. buyers have not completely stopped importing from Russia. They prefer to keep prices lower and limit Russia's earnings instead of cutting off all connections. However, if these cheaper commodities were to vanish one day, it could bring about a big shift in the market. This change might lead to higher prices for gold, silver, and other metals. Let's listen to Eric Strand's interview with SOAR Financially.
Yeah, as you said, we are believers in a sound financial system. On the other hand, we never believe that will happen. And that's why gold and silver is the second best thing. I mean, in a sound system, you actually wouldn't need to invest in gold and silver, but we won't have it. So gold and silver is really, really the way to go to protect yourself. Not just now, but probably for the long time coming. So, and we see this money printing and debt creations going on, and everything is saved with liquidity. I mean, it's already started 2008. I mean, we should have lowered debts in the world after that, and now they are more than 2 times level. So we are not just putting in more liquidity, and then we have some quantitative tightening and so on, but that's always for short term. And what we see now is, I mean, rates have probably peaked or very close to peaking in the US. And I like to see this. I have a graph where gold actually is rather strong also when they raise the rates, and of course even stronger when they lower them again. So and actually in this very strong rate cycle going up, gold is up 9%. So it hasn't been a bad investment when people would believe it would be bad. So and now they're on the top, they can only go down almost from here, and I think then gold will really fly. So gold has shown strength, I would say, being so strong in that environment. I think the market was a bit, or the FX traders, currency traders, they were a bit nervous that if it wouldn't be solved, the risk was, I mean, the US markets would be hit hard, equity markets and all markets, but other markets or other countries would be hit even harder, even if it was not their problem. So I think they got long dollars in before the debt limit was resolved. So that was like headwind for gold against gold. So after that, I think we have solved that. It's over. And I think that makes it easier for the gold to rise. The dollar has been strong with their rate hikes. They were first, of course. And you will have the opposite on the other side when they start to make the pause and then go down. That will be making the dollar a bit weaker. And what is interesting, if you invest in miners instead of the gold, is like if we just play with that miners are a leverage of 2 with the gold commodity. If the gold price goes up 20% and then the miners 40% in US dollars, and maybe the euro goes up 10% against the dollar, as I said before. On gold, you would have a 10% return in Europe, but on the miners, you would have 40 minus 10, 30%. So the leverage for mining investors in Europe is really interesting in this kind of environment. I have one more thing that I think is in the macro that I've been thinking on the last month or so, and that was this war in Ukraine, Russia war. We say that we don't buy any Russian things, but when you see it, all the commodities from Russia is going into the world. Without them, the world wouldn't work. Because I thought that they were sanctioned, but we need this titanium, and the oil goes to China or India, and then it goes back to Europe somehow. And then I understood that Europe or US, they were happy with that because they just wanted the prices to be lower, so the income for Russia would be lower, so not to totally to stop the imports into the world's system. And that made sense. And of course, that is then a pressure on the prices, not just on oil, but I mean, it comes into the metals as well. So, I mean, if Russia has to sell it with a 25 or 35% rebate, that will, of course, make things in the market, because some parts of the market are buying these metals or oil cheaper than the real market. That puts pressure on the price. So I think maybe also when we see that disappear, if we one day would hopefully get a peace or something, that wouldn't be there anymore. No more cheaper commodities than they should be coming out from Russia. And I think that's good for the prices for gold and silver and other metals.
Physical silver traders have encountered difficult market conditions for several years. Shortages have become more pronounced, and the U.S. Mint has struggled to meet the demand as required by law. David Morgan, the founder and author of the Morgan Report, predicts that silver supplies will eventually be depleted and worldwide demand will consume all available silver. This growing demand over the next decade will lead to a substantial increase in silver prices, making it an excellent investment opportunity, perhaps the best in decades. Eric Strand emphasizes that the silver is in short supply, unlike gold. This is having a significant impact on the market as silver is used in many industries. He believes that the dynamics for silver indicate a strong potential for a significant price rise. However, the management of the market by the COMEX has been a major obstacle for the price of silver to soar. Let's hear from Eric Strand's interview.
Well, I do really, really like gold and its properties, but I love silver. So, and that is why the Silver Bullet Fund is our flagship fund and our first fund, and really in my heart. And of course, they all are, but the Silver Bullet Fund is there. And of course, it's, I mean, silver is such a unique metal, being both monetary metal and industrial metal. And what you can see with silver is that we are going for a physical shortage. And a physical shortage on an indispensable metal, I mean, that would make prices fly. We can't see that in gold, a physical shortage, but you can see it, we'll see it in silver. And you cannot do anything without silver in the world. It's the second most used commodity. So I think the dynamics for silver and a dramatic price rise is really, really strong. On the other hand, we have had the COMEX managing the market. So that has been a big problem for the silver price to fly. And of course, again, that's again an opportunity, because if the price would normally have been at 50 now, the potential would not be as much as it sits at now at 23. So we just have to see that this managing disappears. I mean, we have seen the fines for JP Morgan and the other ones. And I mean, the commercials have been going short on the COMEX, big volumes, and then they have done these spoofing trades, and then they've been buying back from the technical funds that have been selling. And then, so they have always gone long on the way down, and they go short on the way up. And they've been allowed to do this for such a long time. And if I'm informed correct, JP Morgan has stopped this, and they are long, and it's Bank of America that is sitting on the short positions and are in trouble if the prices fly. But of course, they will do everything to stop that, and they have deep pockets. But what is interesting is that you may see that if JP Morgan is long and they want to double cross another big bank, and maybe if they can buy it after that, I don't know. But there is a fight between them, and that's interesting. So it really looks like this COMEX situation will change now. I mean, it has been going on for a long time, so it's really hard to wait on it. But when it disappears, so we are free. If we have a free price, silver will go up a lot. That's for sure. Yeah, of course, on this little part that with the investors that are more speculating in gold, it's hard to go maybe really long, as the Fed can talk. I mean, talk is cheap. So it's very easy for them to say that they are going to raise rates and like managing in the markets a little bit. But we are really getting close where that talk will not come true. And I think people really, that will make the market fly. But again, they made it. We're not going to raise rates, but we will do it a little bit later. We have 2 more rate hikes possible and so on. But I mean, that's just talk. And actually, they shouldn't be allowed to talk about that. They should just raise rates or lower rates or keep them on their meetings. I think this talking has been good for them for a while. But I think they talk too much, and that would become a problem for them, that they talk so much about the future when they don't fulfill it.
But
yeah, I think they're getting weak. And the problem with the Fed or central banks is they always go too far. So they lower rates for too long, and then they raise rates for too long because they want an excuse to lower. I mean, they know they will have to lower rates, but they need the excuse to do it. They won't do it like to try to make it soft. They will, something more breaks in the system, and then they have to lower it, and it's not their fault that they are lowering it because they have to do it. So I think they're waiting for the big excuse.
Yeah.
And I don't know if commercial real estate will be the thing in the US that really make them more pain.
Eventually, it'll become a political issue because we have to pay $1 trillion. Oh, not we, but the U.S. has to pay $1 trillion in interest payments every year, at least, and that's when it becomes political because that number is just too high and not financeable anymore.
No, and I mean, they run deficits and big deficits. But they can do that. They can print money and they can do a lot of things. But it's people have, as long as there is trust in them and their system, they can do it. And I'm sure we won't see a big recession because they will print money, or the state will do big projects, whatever it is, to support the system, because no politicians want to see a hard recession. So when it crashes more, I mean, we saw the banks, and I don't think that's really solved. It has been quiet about the banks, but as I said, commercial real estate and all people that have to pay this, have this high cost, it will be a lot of pain, a lot of hurt, and then they will start again. The printing press is really hard to save the system, and of course for gold and silver, that would be a big one.
On Thursday, the price of gold decreased as the value of the dollar increased compared to other currencies. This happened as investors analyzed the recent policy choices made by central banks around the world. During his congressional testimony, Fed Chair Jerome Powell mentioned the possibility of implementing further interest rate increases to control inflation. He clarified that the recent decision to keep interest rates unchanged was a temporary pause and not indicative of the end of the rate hike cycle. However, the financial markets understand that there might still be future rate hikes due to persistently high inflation. Although Fed Chair Powell did not explicitly indicate immediate rate increases, some investors were taken by surprise. As a result, both the US dollar and gold experienced a decline in value following his testimony. That's all from us. If you enjoyed this video, please subscribe, like, and click the bell icon to be notified of future videos. We hope our content has helped you in your trading endeavors.